Welcome, everybody. We're so happy to have you join us for this discussion today. I'm Marissa Guananja, Chief Programs Officer here at the Roosevelt Institute. Today, we have three amazing speakers in conversation about a very simple and yet provocative idea that all economic policy is climate policy. At Roosevelt, we've been grappling with this truth across our program areas. The severity, speed, and reach of the climate crisis is clear and clear every day. New examples regularly show up in the form of natural and economic disasters. The climate crisis is now critical context for all of our work. It's front and center when considering outsized corporate power, industrial policy, labor rights, civil rights, or macroeconomic policies. In all these arenas, the climate crisis dictates what is necessary and what is possible. We recently released a series of briefs that address this provocation from a wide variety of angles, and we hope those of you who have not seen Roosevelt's All Economic Policy is Climate Policy Tools for a Post-Neoliberal Green Transition series will check them out after this webcast. Together, they demonstrate that if all economic policy is climate policy, the neoliberal, racist, market-driven economic policies of the last half century are also failed climate policies. We need a new economic framework to move forward and address the climate crisis adequately and equitably. Today's conversation continues this discussion, and I'm thrilled to introduce our panelists. Amy Westervelt, who will be moderating today's discussion. She's an award-winning investigative journalist whose work has been seen and heard on NPR, in the Washington Post, the New York Times, the Atlantic, the Wall Street Journal, and Inside Climate News. And she is currently a host of the podcast Drilled and Hot Take. Kate Aronoff is a staff writer at The New Republic. She is a co-author of A Planet to Win, Why We Need a Green New Deal, and the co-editor of We Own the Future, Democratic Socialism, American Style. And Rhiana Gunn-Wright is the director of climate policy at the Roosevelt Institute. She leads the think tank's research at the intersection of climate policy, public investment, racial equity, and public power. Prior to joining Roosevelt, Rhiana was the policy director for New Consensus, charged with developing and promoting the Green New Deal. One housekeeping note, please submit questions for the panelists directly to our team via the chat. And thank you again for joining us. And now I'll turn it over to Amy Westervelt to get the discussion started.
Hi, thanks, Marissa. Thanks, everyone, for being here. Kate and Rhiana, I am probably more excited than anyone else here to hear you guys talk about this stuff. You're the two people that I would most want to hear from on this. So to start with, based on your work, I'd love to hear each of you talk about where you see this intersection between climate and economic policy and what good you think could come of really starting to think about economic policy as climate policy and vice versa. Rhiana, do you want to start with that?
Sure, I totally can. I want to echo the excitement. So happy to see you, Amy. Um, so to me, economic and climate policy, it's actually even kind of funny to answer this question because to me, they're just so intertwined. It doesn't actually make sense to think about them separately because of a couple reasons. First, I think as so many people have said before, climate change is the result of economic activity, right? Like we burn fossil fuels, we use fossil fuels, we use energy to power our society, to power our economy. And so the the climate crisis that we're seeing is the result of like how we structured our economies, the direction that our economies are going, just the shape of our economy in general. And then the second reason is that um, our economy is inextricable from the energy that it relies on, right? And so we don't actually just have an economy, we have a fossil fuel economy, right? Just like it doesn't make sense to talk about bodies separate from the sort of like the fact that we eat food or try to plan for how to use a body as though without thinking about what you're putting into it, it does not make sense to act as though the economy is just like some freestanding machine, right? That
Yeah.
isn't reliant upon something and hasn't been dramatically shaped. And I think about your work all the time in this context, Amy, hasn't been deeply shaped by fossil fuel industries, which are some of the most powerful corporations, if not the most powerful corporations in the history of the world, right? And so many things that we just take for granted, like we'll talk about later, from how we measure inflation to how we, even some of our economic modeling to, um, even how we get around our physical environment, all of that comes back to fossil fuels. And so when we start to think about economic policy is climate policy, I feel like it actually opens up a lot of space because all of a sudden you're not in this box where you're just looking at GHG emissions and that's the only metric. All of a sudden you have all of these other tools open to you. You can start thinking about the role of financial policy, right? You can start thinking about um, the role of price controls, right? You can start thinking about um, pushing people away from thinking about their role in the economy as consumers to something else. What does that do in terms of climate? It just opens up all of these spaces. And then what that means is then all of a sudden there's so many more options to actually address the climate crisis than I think what we typically think about. And to me, that's really hopeful and actually helps me feel like there are a number of things that we can do, even when it feels like there's a lot of intransigence and resistance to some of the mainline climate policies that we think of all the time.
Yeah. Yeah. Kate, what about you?
Well, I will just add and say I am also very excited to be talking about this
Yay!
and would agree with everything Rhiana said, obviously. And it's funny, I write about climate 2 or 3 times a week as a beat reporter, and people will always ask, how do you find things to write about that often? And for me, it's sort of hard to think of a story in the 21st century covering politics that is not on some level a climate story, right? And so economics is obviously woven into that. I think, one of the reasons Rhiana pointed out, right, is that everything that happens in the economy is sort of feeding the climate crisis in some way or another. But the way that, sort of disciplines have developed, right, those things have been siloed off from each other, the sort of field of economics and the people who think about climate change. And part of why I'm so grateful to Roosevelt for sort of embarking on this series and having a climate program is that sort of cleavage has really just warped the way we think about both climate change and about economics, right? And so on the economics end, there's this assumption that sort of there is a limitless amount of energy that can be exploited, and that there are the sort of main goal of all economic activity should be just to grow GDP exponentially well off into the future. And on the climate end, right, because there has not been a sort of wide, deep tradition accepted in the sort of mainstream of economics, a lot of the thinking about what climate policy looks like has been sort of outsourced to a very small number of environmental economists who have that sort of mainstream neoclassical framework in mind. And that's the sort of only way to think through what the sort of intersection of climate and economics looks like is what kind of effect will climate policy have on GDP growth, which is a very narrow question and doesn't actually help us, think very much about either mitigation or adaptation or these sort of central questions to the climate crisis, or really to, you know, the sort of benefits, right? That framework always posits climate policy as a trade-off with economic growth. Whereas I think the work that Rhiana has done and that, you know, a lot of these papers really point out is that it's not a trade-off, right? The climate crisis is coming and will have a profound effect on just our physical environment, our economy, on everything. And making investments now, making state-led investments now in particular, can have really big dividends for quality of life, for, you know, just the way we sort of go about our lives. That really is not reflected in this very narrow set of economic models that we will hopefully get to talk about a little bit more. So I have a little bit of trouble parsing them out, and I think, you know, thinking of them in a really integrated way, which these papers do, actually just helps to tell a more positive story, right? And this is the, I think, intervention that the Green New Deal has helped to make in sort of the conversation about climate policy, which is, well, how do we redirect the sort of vast number of resources that we have at our disposal, particularly in the United States, toward solving this, you know, great challenge. We don't have to think about that necessarily as something which is burdensome, which is going to sort of lower people's, you know, people's expectations for what life can look like, but can be really generative and help to redress a lot of those historical harms that the economy, as usual, has created, and thinking about that in a way that's more expansive than just, you know, how do we fix these market failures that come up along the way on the path toward, you know, our abundant future, because we know there's plenty of human suffering and terrible things that have been perfectly profitable and fit well within a sort of the direction of the market. And so, yeah, I mean, I think it's really just baked in a way that I am glad Roosevelt and other folks are starting to bring those threads together.
Yeah. Rhiana, I know one of the papers in this series looks at the role that fossil fuels play in driving inflation, which is super interesting. So I'm hoping you can tell us a little bit about that, and also in conjunction with that, why at this time when we're seeing, you know, inflation being such a problem and we're seeing the negative results of dependence on fossil fuels, why are we seeing this drive to double down on production, despite the fact that, you know, we're seeing every day how bad a decision that is?
Yeah. So this paper is so interesting. And the thing that I start with whenever I think about this paper is the reason that we even had to write it is because energy is actually excluded from all measures really, of inflation that we use, because the prices are so volatile because they are fossil fuels. And the nature of fossil fuel pricing and fossil fuel markets, which I think is just so telling, because what it means is that we've just accepted that volatility as like inherent to our economic system and to our society. But when you actually think about energy prices, they are much more central. And the really, I think, particularly interesting thing about this is that energy is excluded from the official measures of inflation, but energy prices, especially gas prices, are what people use often to gauge inflation, right? Like all that we're hearing about right now is gas prices. And I think that that's because it's something that like people inherently know things or sense things, and they're sensing something, right? Which is that when you include energy prices, they're responsible for a large share of inflation. So just in like March 22, so just a few months ago, 70% of inflation was due to energy. And gas prices were responsible for 75% of that inflation. And the role that energy prices play is not just like in times now where prices are rising quickly and and extreme measures. It's everyday circumstances to much more sort of what we think of as normal circumstances. That's also the case. And energy price increases also have preceded oil, I should say, price increases have preceded recessions by and large. So something like 12 of the last, out of the 12 most recent recessions, 10 were um, preceded by oil price increases. So we're seeing like a very close linkage between inflation and fossil fuels. And I think what we're seeing too, when you see President Biden write a letter um, to oil and gas companies, that's because it's reflective of reality. The drivers of fossil fuel prices are uniquely and especially volatile and really difficult for the government to control or intervene in, which makes it a particularly bad situation. But renewables, on the other hand, because of the nature of their generation, they can offer much more price stability. And because renewables, so much power would be generated through electricity, through electrification, um, that also would offer a lot more price stability because electricity is still one of the much more heavily regulated sectors in our economy. And um, so in a couple ways, the push to increase production of fossil fuels is really wrongheaded, both because it'll be bad for climate, but also because the alternative would ultimately make this situation much less likely to happen in the future, and would give us a lot more stability long term. And I think the drive, why you're seeing the push for production though, is both like just a reaction to people's pain, right? These price increases are tough. They're falling on people who already didn't have much bandwidth to deal with what they were dealing with already, right? The average American is not sitting on a pile of wealth, right? And so price increases are hurting people. And so we want to deliver immediate relief, and people want immediate relief. And so the easiest thing to reach to, particularly in a when people are the problem is gas prices, is right, like let's make more gas, let's make it easier, um let's address that problem in on its own without thinking about its relationship to any of the larger problems that we're facing. And so in a lot of ways that makes sense, but I think we also have to recognize that like it is not the calls to increase the production of fossil fuel, is particularly oil and gas, are happening in a context where, I mean, fossil fuel companies are facing like an existential crisis in a lot of ways. Their existence is being questioned on a level that it has not in a very long time, if ever. And so, and you have the UN, the IPCC paper saying we basically need to stop using fossil fuels yesterday, right? And so this is a real opportunity for them to exploit this moment, and they are, to sort of paint a picture of their necessity and to dig in and to gain access to increased production, whether that's leases, uh, whether that's just access to more drilling, more green lighting of projects, that even though we're talking about the short term, will happen into the long term, right? Leases don't go up after 6 months, 3 years, 5 years, right? And so you're also seeing them recognize that this is a chance to build out, to get sort of hooks in that will be very difficult to claw back in the future. And so the calls to sort of increase production aren't just happening on their own or even just in relationship to the prices, but they're being facilitated by these very powerful corporations who can use this moment to say, look, we really, really are so useful, right? We're really, really so important.
Hmm.
And we're also seeing renewables treated like it's this thing far off in the future as opposed to something that could actually be built out um, with significant speed given the right resources and the right incentives. Um, and so I think it's a combination. And like Kate said, it's again that siloing of climate from economics, right? So we're dealing with these questions about how to deal with inflation and how to sort of right size is the term people keep using our economy and set it on a path as though the path that we choose is unrelated to climate, right?
Right,
As
right.
though we can do those things and climate will just sort of sit to the side and we can get to it when we get to it.
Hmm.
When like all of it is so connected and and a lot of the solutions that we need, particularly around renewables, um, as long as that siloing continues to happen, they seem less like solutions and more like pipe dreams.
Hmm. Yeah. Yeah, I feel like this is where this question of the models is really interesting too,
Yeah.
that Kate kind of mentioned in your first statement too, that like we have all these models underpinning a lot of economic thought that really only look at the cost of climate policy and not the cost of inaction, right? They don't look at the cost of inaction and they don't look at the benefits of action. They only look at what is this climate policy going to cost us in terms of GDP growth or in terms of actual price tags, and even those are sort of not based on what's actually happened in the world. They're often projections of what things will cost. So I think it's important to keep that in mind, and also to know that that is not absent the fossil fuel industry's fingerprints either. They were very early investors in economics programs at universities, and they had a very clear intention there. you know so it's not like the field of economics has not been absent fossil fuel influence either, and the fact that we're still seeing those models even in the most recent IPCC report. We're still seeing these really outdated models, even though we also had like the new chapter on demand response, and we had like these nods to the decent living energy index and things like that, which is representative of this new kind of economic thinking. The majority of it was really pegged to these old school models.
Yeah.
I don't know, Kate, if you wanted to add anything about the modeling thing in particular. I know it's something that you've looked at too.
Yeah, not too much. I think you laid it out pretty well. But it is just so constraining. I mean, the one thing I would add is that the only sort of policy that the models can consider is a carbon tax, and that gets sort of
Right.
wildly misinterpreted in some ways, because if you look at, say, the 1.5 degree report, special report from 2018, right? You have this sort of interesting thing where you have a carbon tax ranging from $250 to $5,000. And so what does a $5,000 carbon tax actually mean? You've banned fossil fuels, right? That is what that means. And the sort of way that gets structured in the report is as a proxy that can be, essentially anything. But a lot of policymakers and enterprising economists will sort of interpret that to in white papers and things to mean that a carbon tax is the only and most efficient way we could possibly solve this problem.
Yeah. Were you to say something, Rhianna? Sorry,
I
go.
was just gonna also mention the short term, right? The short time limits that often we're thinking about the way that we also discount the future, right? In ways that's very detrimental, both when we're thinking about actual people and responsibility to future generations, but also
Mm-hmm.
like the context of this issue with pricing and price stability and fossil fuels versus renewables, a focus on short term that really truncates both possible actions, but also diminishes the impact of moving sooner, right, to
Yeah.
renewables, or, another sort of more climate friendly solution that would address the issue over the long term. And I just think about that constantly. Like it is important to reduce prices in the near term because people are hurting, but we also that question of immediacy and what does it mean to sort of fix an economy while only looking at that economy in the moment and not thinking
Mm-hmm.
about the health of that economy 5, 10, 15 years plus down the road.
Yeah. Yeah, totally. Okay, so if we are going to move policy in the direction of green investment, renewables, these kinds of things, what should that look like? Let's talk about that. So, Kate, what role do you think that the federal government can and or should play in making this possible? I know one of the papers in this series discusses the role of the federal government in industrial planning, for example. And I'm curious what you think that the kind of relevant federal tools are for implementing green policy.
A nice, small, discreet question. What can the government do about
Just that?
climate
I know,
change?
especially, and we're talking about this like as we're waiting for West Virginia versus EPA to come down too. So that's great. Just a little wrench in the works. Yeah.
Yeah, and I'll mention that in a second. I mean, for
Yeah.
me, it's, and this comes through in the papers, it's hard to think of any path toward 1.5 or even 2 degrees in which the government is not firmly in the driver's seat. And so what does that mean? What does it mean to be in the driver's seat? That's not to say that private investment is not involved at some point along the way, that we will have the state making every single investment needed for a green transition, but that the state really does have a very central role and has historically developing all sorts of technologies. Mariana Mazzucato's work is really instrumental in this, but that it's hard to see any sort of big shifts in how the economy has changed in our own lifetimes, right, where the government has not been involved, down to something like the cell phone, for instance, right? That's all DARPA technology feeding into our iPhones and things. So the way I think about this, to build off of what Rhiana was saying, right, is that we do quite a lot of planning already for the fossil fuel sector. And that comes in pretty specific ways through the tax code, right? You have things like the intangible drilling tax credit, which is just for the fossil fuel industry, which has been around forever, these long-standing subsidies for the industry, about $16-20 billion a year on the conservative end. And then there's all of this sort of implicit support through lobbying foreign governments to become sort of markets for US drilled fossil fuels, right? That is a very long established part of US foreign policy, is to create markets for fossil fuels abroad. And so all of that, part of which can be pretty hard to quantify, is planning, right? And I think that's how we have to think about it. And so the challenge, right, is not necessarily, though I think there is sort of new state intervention needed, obviously, but to redirect what we're already doing to things we want. We choose winners actively all the time. And the line the fossil fuel industry loves is that we're picking winners and losers. Let's just pick better winners, right? Let's just pick winners who aren't destroying the planet. And that is, not hard to do. And I think there has been a bit of a shift in thinking, thankfully, that you can see in sort of some elements of policy from the Biden administration, taking, the sort of whole of government approach, not nearly as expansive, as I think many of us would like, but to move away from the sort of long-standing bipartisan fixation on fixing, market failures, on trying to get a carbon tax so that this all works out in the wash. There has been more of a focus on investment. So, what can we do? What might that look like? And, let's say sort of upfront that we probably are not looking at a federal government which is very friendly to passing expansive climate legislation in the next many years, right? Let's hope something comes out of Build Back Better that will be quite small in relief to kind of what's needed. But even if we can't pass legislation, there are all of these authorities that are just sitting there, right? And so there's a question mark over this sort of end of things, but plenty of government agencies have a lot of leeway over the way regulators and policymakers of different sorts think about the climate crisis. The Securities and Exchange Commission has been doing a lot of interesting work on this front, all of which may get tied up in the courts sometime soon, but to even take sort of basic steps, right, like requiring the companies disclose Scope 3 emissions in annual reports that they file, to potentially up to and including like forms of capital controls, right? Requiring that companies which hold fossil fuels also hold, more. Have like more in their reserves that are not fossil fuels to sort of guard against stranded asset risk. So there are these sort of regulatory functions. Obviously, for now, the EPA can still hopefully regulate carbon dioxide emissions. And as you've written, Amy, even this ruling tomorrow probably may not get rid of all of those authorities, right? It could be a sort of narrower reading of the Clean Air Act. There's TSCA, the Toxic Substances Control Act, which could be an avenue toward regulating carbon dioxide emissions. So that will take some courage, I think, on the part of federal regulators to go in the face of the Supreme Court. But we are in an emergency, so I think we can think a little more expansively about that. So there's the regulatory end, and then as Todd Tucker has laid out in these papers, there's also the Defense Production Act, right, which the Biden administration just a couple of weeks ago announced a spending on solar energy, on deploying clean energy, and was recently, thanks to the work of Congresswoman Cori Bush's team, capitalized with $100,000 of actual funding that can go toward that deployment. And so, we have quite a strong executive in the United States as a, holdover of having some quite expansive wars, unfortunately. But we do have quite a lot of power in the executive to use the Defense Production Act, not just for sort of deployment, but also getting through sort of supply chain bottlenecks, using federal land, for instance, for deployment, thinking about things like critical minerals and encouraging investments in critical minerals recycling, even mining, and trying to, reshore at least some of the supply chains for clean energy. And so all of that is still open, right? No matter what Joe Manchin says, no matter what Kristen Sinema says, those are things that the Biden administration can do. And I'll just say briefly as well that, there are all of these other sort of agencies that aren't really thought about as in the realm of climate policy, but are actively doing planning for fossil fuels again. So if you look at the Import-Export Bank, right, funded billions of dollars worth of fossil fuel projects during the Obama administration, has a new program which is likely to fund a substantial amount of gas development. And that is money that is already there. That is money that can go out the door to finance clean energy and renewables. And I would also encourage folks to look at what the Treasury can do around the United States presence at the IMF. Right? We have all of these special drawing rights, which are the sort of reserve currency that is just sitting in U.S. accounts and could be given for free, essentially, to any other country to relieve debt limits, to help other countries to get rid of that sort of burden of debt, which is keeping them from being able to invest in any sort of clean energy, renewable future. And so I think especially as we face kind of a distressing situation in Congress, right? Really sort of triaging what are all of these little pockets of money, what are all these little authorities, some of which are, not little, are quite expansive, that can be used toward the energy transition. I think there's not really an alternative to that. And we know, we'll talk about tax credits hopefully in a bit, but that, we will not, even if Build Back Better passes, there's so much more to be done than that, $300-500 billion can possibly do.
Thank you, Kate. I feel like I learned a lot of things from that.
A lot of it's from the reports. So,
so I'm going to combine a couple of questions we had. Amy dropped off really quickly, so I am going to play moderator for a minute. So just if you could let us know fairly quickly, two things. One, so one of the papers in the series focuses on how shareholder primacy has been preventing utilities from investing in renewables. And so first, can you share one or two examples of how corporate power and just a focus on private profit have helped to block the transition to renewables? And then two, you have recently written about the New York Power Authority and sort of blocking of legislation that would allow them to be a competitor when it comes to power generation, a public competitor for um, in that market, and how there's been a push both from uh, solar companies, which I think a lot of people might not expect, as well as sort of more traditional private sector fossil fuel generators. And so, again, sort of thinking about the focus on private profit, how do we use policy to resist the push for like purely private ownership of energy resources?
yeah, these two things are very related, so I can hopefully wrap them up into one. Yeah, get to folks' questions before too long. On the first count of how shareholder primacy really does hold back the renewables transition, I mean, the cleanest example is that the rates that utilities charge, the profits from those rates go in many cases where this has not been outlawed, and it has been in some cases, to lobbying organizations. And so if you are paying to your privately owned investor-owned utility, there is a good chance that you are funding the Edison Electric Institute, which has lobbied against just about every piece of climate policy under the sun for the last 40 years, right? And so that's a very direct instance in which, the sort of profits that these companies can charge are fueling reactionary fights against climate policy at the federal level, at the state level. There are different versions of this, but has been a sort of direct way that this whole sort of profit model just cuts against any hope for a transition to renewables. And to speak specifically, I'll go to the New York example, right? Which is, you think of New York generally as being a pretty progressive place, right? One of these places where state level climate policy might be possible. What folks might not know, who are joining this call from outside of New York or aren't plugged into New York politics, is that New York State has not passed climate policy in 3 years. And that is with Democratic supermajorities, right? And the climate policy that was passed 3 years ago was a goal to get emissions to 100% renewables, to make the grid 100% renewable by 2040. And there has been no legislation passed to make good on that promise. And this bill that got very close in the legislature this year to passing the Build Public Renewables Act would have been the first thing to do that, and relied on this institution called the New York Power Authority, set up while FDR was governor of New York, to basically allow it to build renewables, right? That was the big thrust of this bill, right? Was to allow this public institution, which doesn't have a responsibility to shareholders, to be an engine of clean energy development and to get renewable power to places it wouldn't go otherwise if those decisions are left up to the big merchant power providers, the big solar companies that feed power into the system, into our deregulated system, as they like to say. And as you mentioned, one of the biggest lobbying forces against that was solar companies, right? Because they feared that a public institution which doesn't have a responsibility to their shareholders would cut into their market share, right? That they would be able to be too good at their jobs and would take away customers because they are able to charge more competitive rates, because they can provide power to people who wouldn't get it otherwise. And in some ways, this is a very old story, right? We know that when the Rural Electric Cooperative started to expand power out to rural areas, some 90% of which lacked electricity at the start of the Great Depression, they were aggressively fought by private utilities, right, who were only sort of extending power to places where it was profitable to do so. Wendell Willkie ran for president as a victim of the New Deal. And so, this has happened before. And what, was exciting about the Build Public Renewables Act as a potential model for how this could look elsewhere is just really asserting that basic fact that, we maybe don't need to have people making a ton of money off of providing an essential service, and that the role for the state in this can be huge. And we know that, the private sector is just not doing what it should. We still, have a grid which is overwhelmingly run on fossil fuels, and even the amount of private investment which has gone toward solar so far, and the costs have gone down quite a lot, is really, up for debate now that we're entering probably into recession, right? There's just going to be less capital floating around the economy and less, free floating cash to fund these renewables companies, many of which are not, sometimes great at making money. And so, the state, especially as we enter into potentially an era of higher interest rates, potentially recession, the state will need to play a much more considerable role in getting renewables to the places where it's needed, which is everywhere.
Yeah. Okay, sorry for my brief absence there, Wi-Fi problems. Let's get to audience questions. We don't have that much time, but I want to get to at least a couple of these. If you have questions, you can drop them in the chat. Please mention your name and your affiliation. You don't have to raise your hand or do any of that. The moderators will see them and feed them to us. So first up, I feel like coming off of what you just said, Kate, let's talk about what role the Fed and its various decisions plays in climate policy. We're hearing constantly about how they're moving around interest rates. So Rhiana, maybe you could take a crack at answering this question from Araceli Martinez. Do you think central banks could play a more active role in achieving climate goals and helping the economy move towards a more sustainable economy? And then maybe Kate, you could talk about how actions at the Fed affect climate policy.
Yeah, totally. I mean, the short answer to that question is yes. The central bank can, and central banks do outside of our borders all the time. So using central banks to push more sustainable, um, to push for more climate policy and sort of more sustainable economic policy is happening in Europe, right? We know that China has built out a ton of coal plants, but also their government plays a huge role, and this is slightly different than central banks, but their government plays a huge role in financing all of their investments in green technology and solar power, and sort of green manufacturing writ large. And so, absolutely, central banks can play a more active role. And in fact, the Fed is a laggard, right? Looking internationally, we're a laggard. We are ranked at the bottom, basically, of central banks moving on climate. And that is, again, because of this argument that, like, um, moving on climate is somehow inherently political, right? Even though climate change poses enormous risk to our economy, and it is the mandate of financial regulators to protect our economy, climate is still treated as though uh, it is not, in fact, as big of a risk as it is, and moving on it is a political question that has to be pushed forward by Congress, and the legislature before the Fed can actually move on it or has a mandate to do so. And so, yeah, I think there's no question that it can. The question is, how do we sort of move away from a world view that financial policy is somehow inherently apolitical, and that climate is inherently political, and that the economic risk posed by climate change is somehow different than any other economic risk, and therefore our central bank doesn't have a responsibility to move on it the way, say, it might if the risk came from, say, housing or another sector that is considered more financial. I don't know. It's really odd how climate isn't considered like part of economics anyway.
Yeah, yeah. Okay, Kate, how about actions taken by the Fed? How do these kind of intersect with climate policy?
Yeah, I mean, there's the sort of low-hanging fruit, and Rhiana mentioned this, that plenty of central banks do all over the world, like stress tests, right? Just sort of running through what it would look like to experience a major crisis. And then, the past 10 years, really since the financial crisis, has seen the Fed expand its toolkit. So traditionally, the only sort of method of intervention the Fed was willing to use was targeting the federal funds rate, right? Raising interest rates. And we've seen, in response to things that it considers a crisis, will expand that toolbox, right? We'll create new programs, we'll use new authorities, those sorts of things. And so I think you can think about climate sort of as a crisis, and whether the Fed does that or not is up for debate, but really it is a quite powerful institution, and can make a pretty big difference. And one thing just most immediately is not hiking rates so aggressively, right? Jerome Powell has admitted that the Fed has very little control over gas prices, which are this leading driver of inflation. And their best solution for rates to, get at rising gas prices to make people poor, to get wages down, as he said a couple of weeks ago, right? And that's, I think we can maybe expect a little more from our central bank, from one of the most powerful institutions on earth, and think, well, maybe we'll throw a lot of people out of work and then they'll buy less gas and that'll bring down the price of gas. Not doing that, I think, would be a nice step for the Fed to take, not just raising interest rates as aggressively as possible in the hopes that maybe that will help bring down inflation.
Yeah. I know. I just think of how they handled the pandemic. Actually, is a really good example of what they can do when they take a problem seriously. They helped the oil companies a lot. Yeah. Okay, from Arya Harsono from the World Resources Institute. This is a great question. What role will and should unions play in a just transition? I know this is something we've been talking about for a long time, but especially now when we're seeing unions starting to have some big wins lately. What do you both think about that? Rhiana, you want to jump in?
Yeah, I mean, I think unions have such a crucial role to play in a just transition. One, in terms of training, right? Unions are a huge organ for in our current sort of workforce development system, and that shouldn't change, even as the economy is changing. Unions as training grounds and trainers is just so essential, and should be considered real partners in a just transition because training is going to be crucial um, to that. And we want high quality training that leads to high quality jobs. Um, and I think unions are a really important bridge there. The second thing that I will say about unions is that unionization is a big part, is really important when it comes to a just transition because um, unfortunately, a lot of, say, renewable energy, say a lot of solar, isn't unionized right now, right? Just because something is good for the planet doesn't make it good for workers automatically. And the like in Kate's example with the New York Power Authority, it's still the solar industry. Like it is still an industry that has a drive for profit, and when it comes to having lower labor costs is always helpful in that regard. And so unions still need to be and actually need to have a more central role than they have right now because part of a just transition is making sure that in an economy powered by renewables and clean energy versus a fossil fuel based economy, that employees actually have different um, power relationships with employers, right? You can't have a just transition without changing that dynamic, and unions are central to that. Just like you can't, part of what a fossil fuel based economy is really based on is exploitation, right? And having workers without the power or the protection of unions is really key and central to that. And so a just transition isn't just about moving to a different form of energy, it's also about moving to a different form of economy where the power relationships that keep that economic model, that economy going, and the model of that economy in place is different. And workers have more power. And so unions are just incredibly central to that. And also, unions are huge power players. So, having them behind a transition away from a fossil fuel economy to a greener, more sustainable economy, just I think in so many ways makes that much more likely to happen and to happen more quickly uh, than if they're not in the mix.
Mm-hmm. Yeah. Kate, you want to add anything?
Yeah, the only thing I would add is that, there's been such sort of fixed politics around some of the jobs versus climate discussions, right? Where you have usually a sort of crew of building trades unions, workers in the fossil fuel sector versus like tree hugging environmentalists has been the story for so long. And something that's really hopeful beyond like the fact that people are getting unionized, right, in these Amazon fights, the Starbucks fight, right, is that you see some of those same unions really taking a different approach to new organizing, right, sort of getting out of some of the risk aversion that has defined a lot of those unions for a long time, and a lot of unions for understandable reasons after enduring 40 and 50 years of attacks from the right. But you look at sort of the Teamsters, right, really getting excited about some of this new organizing, joining on to these rank and file fights, and that is really great because if we're going to create millions of green jobs, those are workers who can be organized and they can build the ranks of unions, and that is in their self-interest as well as the self-interest of the planet to have a much better sort of workplace for solar, for wind, for any number of sort of green jobs, and not just like assuming sort of fatalistically that solar in particular will be this anti-worker place, because people have fought to organize industries, and this will be no different. The other just the other thing I would add is that there is a lot of already low carbon work which is unionized. If you look at nursing professions, right, teaching professions, these are low carbon jobs. These are unionized workplaces, and in many cases, not all of course, but those can also be sort of engines of both the political movement for green investment, but also for the jobs themselves, right? And building out the already sort of low carbon sectors of the economy that make our lives good and make help us help us age, help us raise children, all those things. And so those are not always starting with the sort of toughest fights and the workers who are most sort of embedded in the fossil fuel economy, but thinking about the already existing green economy as well.
Mm-hmm. Yeah. Okay, one last question from Bernie Gallagher, Center on Budget and Policy Priorities. Okay, the priorities of the environmental movement have tended to leave certain communities out, particularly people of color. Big environmental groups have not been the best allies to local, smaller communities of color-led organizations who are leading the environmental justice fight. What can DC policy organizations do better to help broker the nexus between big environmental groups and smaller advocacy groups in the community? This is a good question.
Yeah, I do have one answer to that I feel like is an example of it is going on currently. I think one of the things that DC policy organizations can do is actually identify issues and policy fights that are really important for smaller advocacy groups, and then the positions that bigger environmental groups can and should take that would be supportive of what at least we know advocates from those groups have said would be really important. So one example of this is clean energy tax credits. Right now, they're really there's a big push, particularly from Senator Manchin, to strip out direct pay from and refundability from those tax credits. And let's face it, tax credits are not an ideal vehicle, right, in so many ways for public investment. Um, just if you're talking about individual tax credits, they assume they don't fix affordability to actually say put solar on your home. You still need a significant upfront investment. Tax credit doesn't fix that. It assumes that you have a year to wait to get whatever help is coming your way, which you might not, right? And it doesn't fix some of the larger issues of accessibility, which, say like for renters, there's a split incentive. Landlords don't get the benefit of lower energy bills, so why would they do it? And renters don't have the power to put solar on their buildings, right? Tax credits don't do anything to solve that. That being said, if this is going to be, and it looks to be the main vehicle for investment in climate in any reconciliation package, direct pay is one of the only things that actually helps to make tax credits, and clean energy tax credits have a particular history of being like very inequitable. It's the only thing that helps make them a little bit more equitable, right, on the individual level, but particularly when it comes to um, the corporate tax credits. Having direct pay means less reliance on tax equity investors, which means much less power for Wall Street to dictate um, what projects get built and what projects don't. And we know that if they're the ones helping to dictate that, what they're going to be looking at is not what projects help serve low income, disadvantaged, frontline communities the most. It's what projects are going to make the most money. And so that's an example of an issue that like maybe big enviro groups don't fully understand the contours of, but DC policy groups can say, hey, this fight is happening. These are the issues. This is the way that this happening could negatively affect people of color. Really need you to get in line and push for direct pay in the tax credits, not just to have tax credits, which is often sort of the line like, let's just get climate policy, that's enough. but for DC policy or organizations to really hold the line on what climate policy needs to look like to be just and helping to be that bridge.
Yeah. Do you want to add anything, Kate?
I'm so glad we got to talk about tax credits. Yeah. Yeah, I mean, I would just say, like, you know, as a reporter, I can speak a little bit less to sort of DC policy world, but as a reporter, generally I found that the people who like have to live downstream of policy probably have the, you know, generally have the best ideas on how to change it, at least in terms of like direction of travel. And like, if you have to live with a fossil fuel plant in your backyard, you know they're bad, right? You know that they're pouring toxins into the environment. And so I think the tax credit example is a good illustration of that, where the problems might not be obvious if you're like sitting on K Street, but if you know, have tried to put solar panels on your home as a renter in a low-income neighborhood, like, you know, the tax credit system does not really work.
Yeah. Yeah. Awesome. Thank you both for being so smart and sharing all of your smarts with all of us. I'm so glad that we got to have this conversation, and thanks everybody for coming. This is great. Don't forget to check out this whole series of papers. They're excellent. Really, really good. I don't know if you guys have parting thoughts you want to add.
No, just thank you for coming. Apologies if I seem low energy. Childcare availability issues.
Know that, heard that. Yeah.
I'm really so happy to talk about this series and just can't thank you, Amy and Kate, enough for joining me to do that.
Yeah, so good to talk about all this stuff, and thank you for all the work to get the series together. I think it's a really valuable set of papers.
Yeah, same. Awesome. All right, that's it. Thank you.